Ladies and gentlemen, thank you for joining us tonight. We'll go ahead and get started. And I'm Alex Burden. I'm the Executive Director of the Truman Library Institute, the nonprofit partner of the Harry S. Truman Library. And I want to welcome you to the 8th Truman Medal for Economic Policy Awards ceremony. It's a great crowd. Love being back in the Truman Forum at the Kansas City Public Library. We've had many, many wonderful programs here. Especially like seeing it when we've got the overflow seating in the back and on the side. So thank you all for being here. Thanks to our board. Many Truman Library Institute board members are in attendance. Appreciate your time. Donors, friends, thank you for taking your time on a rainy Thursday night to join us. Just a couple of comments about the Truman Library. I think the most important one is if this event in any way triggers you to want to go out to the Truman Library, don't. Because it's currently closed and will continue to be closed until next September. If you didn't know, we're in the middle of a massive renovation project, the largest project at the Truman Library since Harry Truman and his friends raised $1.7 million in 1955, and the library was dedicated and opened in 1957. So please stay tuned until September and curb your enthusiasm and make plans to join us with a reopened Truman Library. We're in the middle of a fundraising campaign. If you're wondering what we're doing with the library closed, we're raising money. It's a $30 million project. We've raised $26.5 million. We have a few million left to go. If any of you have a few millions laying around, let us know or let Kim know. We'll be reopening with great fanfare. We've got programs all over the community. You can learn more about what we're doing at trumanlibraryinstitute.org. And a program like tonight is offered by the Truman Library and the Truman Library Institute to share interesting chapters of Truman's life, the presidency, and American history with Kansas City audiences. In tonight's case, we'll be sharing the economic policies and economic history from the Truman administration. And Truman was confronted by daunting economic challenges throughout his time in office. In particular, the period immediately following World War II, when he and his advisors faced a number of major obstacles, including the conversion of a wartime economy into peacetime economic expansion, refinancing the huge national debt caused by war production, and stimulating the economy and economic growth. In response, the Truman administration created a number of major institutions, policies. Domestically, the Council of Economic Advisors and the Monetary Accord of 1951. Internationally, the United Nations, the World Bank, the International Monetary Fund. And as I was researching Truman and his economic policy award earlier today, it occurred to me that one of his greatest accomplishments, period, is something that he doesn't get a lot of credit for in terms of economic achievements. And most of you know what this is. It's the Marshall Plan. And the Marshall Plan and the post-World War II aid programs were phenomenally successful. There were two well-known economic historians, Bradford DeLong and Barry Eichengreen, went so far as to state that the Marshall Plan was one of the greatest economic policy successes in American history. I'll let the economist on the front row here, much more intelligent than I am, to debate that either as part of our panel tonight or by themselves at dinner maybe. But during this pivotal moment in world history, Truman and his administration worked with Congress in a bipartisan fashion. Imagine that. Wouldn't that be nice in today's day and age? On a series of programs that provided financial support, technical aid and advice, and other forms of economic assistance to countries that were in ruin following World War II. Just a few stats. Truman Doctrine, $400 million provided to support the economies and militaries of Greece and Turkey. The Marshall Plan, $13 billion in economic assistance to help rebuild Western European countries. The U.S. also provided $6 billion in grants and credits to Asian countries during Truman's administration, and an additional $500 million to the Middle East. Combined, that was $20 million. And if my rough math is accurate, that's the equivalent of more than $150 billion in today's money. And it wasn't just the money they provided. There was massive aid delivery infrastructure and support services were established during the Truman administration to maximize the impact of these relief funds. Economic policy changes were obviously an important component of this. such as removing or reducing interstate trade barriers, revising or eliminating regulations, modernizing or creating from scratch industry, increasing productivity, etc. And as I said, these programs were tremendously successful from both the political and financial standpoint. Thank you for tolerating my excursion into Truman history. I can't resist the opportunity to do that. Getting back to tonight's program, the Truman Medal for Economic Policy. This event was created almost 14 years ago to recognize individuals who have made extraordinary contributions to the formation of economic policy, while also acknowledging the significant impact our hometown president, Harry Truman, had on the American economic system. The Truman Medal for Economic Policy is organized through a partnership between the Truman Library Institute, the UMKC Block School of Management, we're represented here by Dean Brian Clace, the Missouri Council on Economic Education, represented here tonight by Ron Miller, and the Economic Club of Kansas City, represented by President and Executive Director Alan Barkman, who you're going to be hearing from shortly. Thank you all for your organization's efforts and your efforts to make this event possible. I also want to thank a staff member of mine, Lacey Helmig, I'm basically spending most of my time fundraising. So Lacey led this program for us and did a great job. Lacey, thank you for that. I also want to support the Federal Reserve and Esther and her staff for her important support of this project. Platinum sponsors deserve a thank you: Americo Financial Life and Annuity Company, Country Club Bank, and the Economic Club of Greater Kansas City. These and other sponsors noted in your program make this event possible. But wait, there's more, just a few. Other sponsors, the J.E. Dunn Construction Company and the Ewing Marion Kauffman Foundation, helped establish an endowment 14 or 15 years ago that helped fund this award and helped fund this program. And I would be remiss if I didn't thank Tom McDonald for the important role that he played in establishing this event many, many moons ago. So with that said, thank you all for coming. I hope you enjoy the program. We've got a fascinating evening tonight with David Von Drehle and Janet Yellen. I want to introduce Alan Barkman, who's going to come up, and he's going to introduce our guest of honor and present the Truman Economic Policy Award. Alan?
Thank you, Alex. Good evening, ladies and gentlemen. As Alex described, the Truman Medal for Economic Policy was established to recognize extraordinary contribution to the field of economics, and especially the application of economics in public policy. Janet Yellen is a clear choice for this year's Truman Medal. Dr. Yellen is one of the most influential economic thought leaders of our time. She served as chair of the Federal Reserve's Board of Governors from 2014 through 2018. Today, she's a distinguished fellow in residence in the Economic Studies program at the Brookings Institution. She previously served as vice chair of the Federal Reserve Board, also as president and chief executive officer of the Federal Reserve Bank of San Francisco, and also as chair of the White House Council of Economic Advisors. Ladies and gentlemen, it's this extraordinary record of contribution to economic policy that we recognize this evening. It is a great honor for me to present the 2019 Truman Medal for Economic Policy to Dr. Janet Yellen. Dr. Yellen, could you join us, please?
Thank you. Thank you. Thank you. Thank you.
Now I'd like to invite to the stage Mr. David Von Drehle, a columnist with the Washington Post, who will join Dr. Yellen in conversation. Thank you very much.
Thank you.
Well, it's a great pleasure to be here with you, and intimidating indeed. the qualifications to be a newspaper columnist, as I'm sure many of you have already figured out, is a willingness to make an idiot of yourself in front of a large number of people
I'm sure that's not the
by
case.
pronouncing on subjects you know nothing about. And I'm enormously qualified. But the good part is the chance to talk to someone who actually knows what they're talking about for a change, and that certainly describes Dr. Yellen. I thought, since Alex raised the question, that we might start out with your thoughts about Harry Truman as an economic leader and his performance as a president. He certainly, in my mind anyway, his presidency is the beginning of the modern world, and I imagine that's true in your field as well.
Yes, I would strongly agree with that, and I think Alex gave a wonderful summary of his contributions, and the Marshall Plan certainly should rank very, very high in that list of accomplishments, but also the establishment of the Council of Economic Advisors and the Employment Act that established goals for good economic policy making that I think have served this country well. And the Council of Economic Advisors was, I served there as chair, and it's a really unique and very valuable institution. I think he envisioned it as a kind of economic consulting operation sitting in the White House, that he had the vision of bringing in professional economists who could inform government policy making based on the best available research and analysis of options in a nonpartisan way. And I think that's become a core part of how good policy is made in the U.S. government. It certainly established a set of values that we want economic policy to be informed by the best professional analysis, analysis of pros and cons of different alternatives, and understanding of what their benefits and costs are, by informed professionals who are devoted to public service. And that's a set of values that the Federal Reserve also adheres to. So I think he introduced a cadre of very public-spirited professionals in the government who have had generations of contributing to good economic policy making in the United States.
You mentioned the presentation of the costs and benefits, which in one, I don't know if it's apocryphal or not, but in one meeting famously led President Truman to wish he could find a one-handed economist because he was constantly being told on the one hand and on the other hand.
Well, you're absolutely right about that, and the structure that he created, I think, was specifically intended to create that problem for him, that he would hear about alternatives, and there may be no perfect alternative, but it's important to understand the merits and problems associated with each.
When you're in those sessions and understanding that you're counseling a person who has to make these decisions that are going to affect the entire world's economy, certainly the world's largest economy, how intimidating is that experience? And is it difficult to say, no, I emphatically believe this is the thing to be done?
Well, I think economic policy makers are very well aware of the extraordinarily important role that the U.S. plays in the global economy. And President George and I, in fact, were just discussing the fact that the Federal Reserve really is viewed around the world as the world's central bank, in the sense that what the Federal Reserve does has important impacts on every country around the globe. And although the Fed has a domestic mandate, understanding that what it does affects the entire global economy, which spills back onto the economic prospects for the United States, is an inherent part of policy making. And of course, the same thing is true in the White House at the Council of Economic Advisors for other policies. And so that is a central theme.
I want to get, obviously, to central banking because it's such an interesting time for central bankers that you've lived through. But I'm curious just to hear a little bit about your creation story. I'm guessing that when you started in economics, it was not seen as a very female-friendly profession, or am I wrong about that?
Well, I'm fortunate that my mother was very interested in economics, and I perhaps ended up going into it because it was something that she was very concerned with. My parents lived through the Great Depression and told me stories about the suffering associated with it when I was growing up, and when I came to study it in college, I think that theme of joblessness and the problems that joblessness and a shortage of jobs, the suffering that that causes to families, was something that had taken hold in my psyche. And I was very interested in understanding what kinds of economic policies could be used to keep the economy operating as close to full employment as possible. So I had a deep attraction to economics. There were not a lot of women, you're right, in economics when I started out. I think, it is a problem for many women, and the economics profession is now recognizing that the culture of economics often discourages women from being interested in it.
How so?
Well, for example, in most colleges and universities, women are about a third of majors.
Right.
And they're more than half of the undergraduate population. So, and it's less true that disproportionately low share of women in economics contrasts with the STEM fields, for example, where they're better represented. And we've seen that the higher you go in the professional ladder in economics and in business and finance, the lower becomes the representation of women. The American Economics Association last year did a survey to try to assess the climate in economics and how it affects women, and the results were frankly quite disturbing, that women often feel that their accomplishments are not recognized, that it's a hostile and aggressive environment that is not conducive to supporting women and minorities. And so it's become a prime topic, and rightly in my mind, to think about ways to change the cultures to attract a more diverse group of women and minorities. I'd say from my own point of view, I was very fortunate. I had very good mentors both in college and in graduate school. Although women were in a tiny minority when I studied economics and on faculties where I served, I felt that I had many opportunities, and certainly within the Federal Reserve, I felt that I had wonderful opportunities. But I may be the exception rather than the rule. And so within the Federal Reserve, we've been very focused, and I know they remain very focused on trying to create an atmosphere that will be more conducive to success, mentorship of women and minorities.
Well, we certainly are happy with our local example of your success.
Absolutely.
Is there do you feel as a woman economist that you approach any questions differently than the stereotypical male economist?
So I think I use the same tools and have the same theoretical toolkit that any economist would have. But I think our interests, professional interests, are colored by our personal experiences. And in my case, the fact that my parents lived through the Depression, that they were influenced by it. My father was also a family doctor, and he practiced in a blue-collar neighborhood where people often lost their jobs. And his office was in our house, and I often heard stories over the dinner table about the suffering that came to his patients and their families from downturns in the economy. So, for me, that particular experience, I think, made me always very interested in jobs and whether or not they were available and what could public policy do to ensure that we have a healthy economy where people who want to work will find an availability of jobs. So I think one's own background and interests in economics, women disproportionately tend to, if you look at what they study in economics, they tend to be attracted to health, education, children, families, labor, subjects that have tend to have a human aspect to them. And of course, women and minorities work in every field.
Right.
But background and experience does make a difference in terms of what people focus on.
It seems to me, and please correct me if you disagree with this, but that as we're moving well into this 21st century, I'm starting to see that we're in a historical period that maybe begins with the end of the Cold War and is still playing out, and it involves this technological revolution that's upending economies, and it involves globalization, and you've had the ringside seat on that. You were chairman of the council in the White House in those fantastic boom years of the late 90s, and then you've been right there in the thick of it ever since.
Right.
Do you feel like there's a narrative of that period, an economic narrative, and if so, what are a couple of the high or low points?
Well, that's a big question.
Yes.
And so, I would say a theme from perhaps the mid-'80s to the present that connects with globalization and technological change is that we have seen inexorably widening inequality. And the median worker in the United States, if you look at how they've fared since the mid to late 80s, there have been some improvements in real wages or inflation-adjusted incomes, but the improvement is slight. So a good half the population has seen almost no meaningful gains in real income since the mid-'80s. And the top 10%, and especially the top 1% and 1/10% has done very well. You've seen widening gaps. If you look at the gap between what college and high school educated individuals earn, that gap has continued to widen. So GDP and GDP per capita have grown immensely over the post-war period, sometimes at faster rates, sometimes at slower rates, but globalization and technological change have been the drivers. But those drivers have not, they've made the pie, the nation's economic pie grow impressively. The division of that pie has become more and more unequal. And I think that's driving very serious problems in our society, and many communities that are seeing a loss of the kinds of jobs that once upon a time were good middle class jobs that led to a secure, a pretty secure life. And some combination of technological change that's favored those with more skills, and globalization that's given other areas of the world has led to great gains there, but has hit low-income, low-skilled workers very hard. That is a theme, and it is having tremendously important and disruptive effects on our society. But now, the macro theme, you pointed to the second half of the 90s. So this trend toward rising inequality, it's been there all along, but having a very strong economy and a very strong labor market can tend to mute it or even reverse it for a while. And so what we saw during the second half of the 90s was a period in which the unemployment rate fell to very low levels. Inflation wasn't a problem, and the labor market was extremely strong. And so that trend toward rising inequality, it was broken for a little while and actually began to show some signs of being reversed toward the end of the 90s, before we hit the recession in 2000. And we've seen the same thing during this very strong expansion. So, it's been 50 years since we've had an unemployment rate of 3.5%. And what happens when the unemployment rate falls to such very low levels is that those groups that have been hardest hit by technological change and globalization, they really see their situation begin to meaningfully improve in a very strong labor market. So we're seeing, for example, African Americans that at the height of the Great Recession, their unemployment rates rose to 16%, been about 8%, always higher than white Americans, rose from about 8 to 16%, and now have basically fallen to the lowest levels since we have kept track of them around 1952 to around 6%. And the biggest wage gains are actually at the bottom. So we know that if we can keep the economy growing strong, have a good, healthy labor market, it really helps those that are being most adversely affected by these longer run structural trends. So I've seen it as, a very high priority. Well, I think we need to address these adverse structural trends through economic policy, but also keeping the economy operating with a strong labor market is an important antidote to those adverse trends.
And it seems to me that you're describing it, when you're talking about structural issues, those are, correct me if I'm wrong, political questions. The tending of the economy and driving toward low unemployment is a role for central bankers.
It certainly is. It's arguably a role that sometimes needs to be shared with the rest of government, but certainly central bankers see maximum employment as, and price stability, of course, as their mandate, and that's that's what was in the Employment Act.
Let's talk a little bit about the past, I guess, 11 years, 12 years since the Great Recession, when arguably the world has relied on central bankers more than ever before. I think case
Yes.
could be made. Political systems are not functioning at a very high level right now. I think everybody would agree with that. Explanations might be different, but the result. And so not only in the United States, but around the world, we've turned to our central banks. Do you feel that's been appropriate, or has there been too much reliance on monetary policy to address these big structural issues that you're talking about?
Well, it's an important and appropriate job for monetary policy, but sometimes monetary policy needs help. And the Great Recession was a very severe downturn. The Fed and other central banks responded quickly and massively and aggressively to do everything that they could, but unemployment was spiking up to 10%, and monetary policy works with lags. And we did have fiscal policy kick in for a couple of years to support the economy, and I think we had a faster recovery because of it. But we have less fiscal space in the United States and many countries than I think would be desirable. And before long, by 2011, the focus in the United States on fiscal policy was becoming deficit reduction and worrying about long-term adverse trends in U.S. debt. And fiscal policy went from being a stimulus to being a drag at a time when the economy was still, it was recovering, but it was still pretty weak. And that meant the Fed had yet more work to do. It was like our partner was decided, I've kicked in, but I'm finished, and I'm out of here, and I'm passing the baton totally to you. And it was unthinkable, to me, if someone had, it was in December of 2008 that the Federal Reserve took its overnight interest rate down to 0. If someone had asked me at that time, how long do you think short-term rates will stay at 0, I would never have imagined that it could be 7 full years. It was December of 2015 when we first began to raise rates off the so-called zero lower bound. And it basically says we had an economy that was so weak, where spending was so inadequate, that central banks really were struggling to do everything they possibly could to get the economy moving again. And even having just 0 short-term interest rates wasn't enough. And we were forced, and this is true in Japan, in the Euro area, and it was true in the UK, to really begin to think outside the box. What can you do when you've taken your normal tool and you're using it to the max? What more can you do? And central banks began to resort to unconventional policies, buying longer-term assets to push down longer-term interest rates, offering forward guidance about the path of short rates to accomplish the same goal. Now, we never did this, but many countries around the world have actually gone to negative territory in interest rates, which I think most normal people find very hard to get adjusted to, or to think about living in a world where in Germany now, if you want to buy a 10-year German Bund, you get less than a euro back at the end of 10 years for every euro that you pay for that bond. I mean, they're actually negative yields. So monetary policy has been stretched to the max, and I do think there are limits on what it can accomplish. And, you know, if this were just a problem that occurred because of the financial crisis and the Great Recession, and we could look forward to going back to more normal times where this will end, interest rates will go back to more normal levels, that would be one thing, and it would be something good to look forward to. You'd say, well, monetary policy will have the same powers it used to have, but unfortunately, it looks like this trend toward weakness in demand in the global economy, or how can I put it? You know, the level of interest rates in the global economy really depends on the strength of propensities to save. So people around the globe are trying to make loans to save. And what determines interest rates? It's how many people are lining up to borrow those funds.
Right.
What's the strength of investment demand? And interest rates tend to be high when there are a lot of people who want to borrow money and a shortage of saving. And unfortunately, we've got the opposite problem, not just in the US, but in the global economy, which is the propensity to save is strong, and the demand for those funds for investment is weak. And that results in a low real interest rate environment. And as we go back and look at experience in the United States, it looks like this problem of a drift to a world with low real interest rates actually predated the financial crisis. And most researchers believe that this is the new normal, that we're going to be in a world likely where the average level of interest rates is going to be low. And what that means for central banks is the normal tool of monetary policy is cutting interest rates in a downturn. In typical post-war US recessions, the Fed has cut interest rates by 5 full percentage points. Well, now the Federal Open Market Committee estimates that the normal longer run level of short rates is likely to be around 2.5%. With 2% inflation, that's 0.5% in real terms.
Right.
And you don't have room to cut
Right.
5 percentage points if you're starting from 2.5%. So this is a world where, if this indeed is the new normal, and it may well be a reflection of slow productivity growth in most advanced countries and aging populations, demographic trends we're seeing around the world. If this is the new normal, then the kinds of policies you're seeing with negative interest rates and asset purchases and central banks struggling to keep their economies on track and worrying now about inflation being too low rather than too high, this may be the new normal. And I guess I would say, of course, central banks should make the contributions that they can, but other instruments of policy are needed in addition to that, and I think fiscal policy tops the list.
You talked about some of those big structural drivers. Where do you put demographics on that list? Is it number one? Because, I mean, I just think about myself. You know, I was borrowing and spending 20 years ago, and now I'm saving, and there's nothing that I want to buy. And there's more old people like me all the time.
Yeah, me too.
Right. So, and if we looked at Japan, which I guess is so far
Further
has
along
been
in
the
that.
leading character in this drama, they are the leading aging population
Yes,
in the
and,
developed
I mean,
world.
and Europe as well, and China has aging population
Yes.
as well.
We were counting on China to produce all the buyers, right?
Right.
The customers.
Right, and so much of the world does have aging populations. It's slow labor force growth, so the normal level of GDP growth in most advanced economies has fallen. Productivity growth has also been disappointingly slow. And I know I feel I'm seeing technological change every day in my life. And when people tell me productivity growth is slow, sometimes I find it hard to understand
Me
how
too.
that can be. But the truth is, for the last decade, productivity growth has been dismal. And it's not only a US phenomenon, we're seeing that in most developed countries. So the normal growth rate of the pie of GDP in the US economy, it's not that high. Again, the Federal Reserve in their surveys currently is estimating the longer run normal growth rate of the US economy at 1.9%. So that's the estimate of how fast the US can grow with essentially a stable labor market or a constant unemployment rate. The unemployment rate has been falling where utilization of labor is been getting tighter and tighter. That can't go on forever, and so although we've been growing in the US a little bit faster than 2%, eventually the unemployment rate, there's only so low it can go, and that says growth is likely to be around 2% going forward. And in that kind of economy with growth that slow, that also tends to depress investment spending,
Right.
because firms invest to keep up with the growth in demand that they see, and it just isn't that great. And so I think both of those things are important.
I developed my new theory about productivity. For what it's worth, I developed on the drive over here when I heard on the radio they were doing a report on in the thing in video games now is that you buy little loot boxes, they call them, inside the video game, and you open them up and there's nothing really there, but you've spent money. They estimate it's going to be an $80 billion business, and I don't know how much of that's going to be my son in the basement, but there's a lot of people in the basement with their video games, obviously. So then, if we need a bigger role for fiscal policy because of the limits to the tools of monetary policy, should we be worried about trillion-dollar deficits as far as the eye can see?
I'm worried about trillion-dollar deficits as far as the eye can see. I mean, in an economy that is this strong, with this low an unemployment rate, I don't believe it's appropriate to have trillion-dollar deficits. This is a time when the budget should be in balance or even in surplus in order to enable us to have the fiscal space to use fiscal policy actively when there is a downturn. If you look at the longer-term projections for the U.S. debt, they are frankly scary. Because, and this is not new, this is something that we've known for decades, and it's something I worked on at the Council of Economic Advisors. With an aging population, the ratio of retirees to workers in the United States is rising. And on top of that, healthcare costs have been, on per capita terms, rising reasonably rapidly. And those two things mean that three programs, Social Security, Medicare, and Medicaid, those programs continue to grow as a share of GDP. I think they're currently something around 10% and rise to something like 15% over the next 20 years. And the resources to pay for them. I mean, right now, we have, as you said, trillion-dollar deficits with no projection that that will go away. And as the population ages and these healthcare costs trends continue, the debt begins to grow relative to GDP really without limit. So we're on an unsustainable course. It's fortunate in a way that interest rates are so low because if you go back pre-crisis, the US debt to GDP ratio was something like 38%. Today it's 78%, so
That's
it's roughly
right.
doubled. But interest as a share of GDP has remained completely flat because interest rates are so low. So in that sense, in a low interest rate environment, maybe having more debt is safer, it's not as burdensome, but we're on an unsustainable course and need to do something about it. So, you know, I would like to see fiscal policy as available as a tool we could use when monetary policy is overburdened. But to have that ability to do that, we need to improve the underlying fiscal situation.
You, when you were in the White House, obviously one of the major domestic policy discussions going on in the Clinton administration was about use of technology to bend the cost curve on medical costs, which are, I agree, it seems to me it's such a huge issue over time. What's your level of optimism about that now after having watched that those trends for 20 years?
So we've seen in recent years some mitigation of that trend. There have been some positive developments, and I'm not really an expert on healthcare costs. I do believe there are changes that are possible in the way the healthcare system works that would make it more efficient. We spend more per capita on healthcare than many other advanced economies, and I do believe it could become more efficient. But these are very, as you know, very controversial topics where it's very hard to make progress.
We've seen, and I don't want to take you anywhere you don't want to go, but your successor as chairman has come under a level of public criticism from very high levels of the government that that have not been traditional and that you didn't experience to that degree. What's your level of concern about politicization of the Fed?
So I am very concerned about politicization of the Fed. I strongly believe in central bank independence in monetary policy. It's been a trend that has been, or a situation that has been accepted all over the world. It clearly results in better economic performance, stronger GDP growth, lower inflation when a central bank is given a mandate. So it's not that it should be able to decide what its goals should be, but the Federal Reserve's been given a mandate by Congress for price stability or low inflation and maximum employment. But when it has the ability to make decisions about how to achieve that mandate in a way that is not political, is fact-based and based on good analysis. And I've seen that process works. It's something I think is very important to good economic performance in the United States. And we've had many, many years in which it's been recognized by administrations. I think this really started in the Clinton administration, but it continued until recently, that White Houses recognized, presidents recognized that they should not interfere with central banks. I never had any pressure at all during my time in the Fed. I would meet, and my predecessors met regularly with Treasury secretaries or occasionally with the president to talk about what the Fed was doing, discuss the economy, but never any criticism, never any pressure about what to do. And I think when the Fed is able to, and it is able, it's a wonderful, strong institution with diverse viewpoints around the table, making good decisions, you get the best economic performance. And it's structured to preserve and enhance its independence. The governors have long terms. There are Reserve Bank presidents who are differently appointed and participate in the process. But over time, if a president wants to replace people and criticize it, and a central bank needs a level of public support too to be successful. People have to trust it, feel that what it's doing is advancing the public interest and in line with congressional goals. And a president can use the bully pulpit, I think, to begin to undermine that public confidence in the behavior of the central bank, and that would really greatly concern me. And of course, over time, appointments, if the Senate is willing to go along with it, can make a difference to how it operates. Right now, the Fed is not political at all. Politics never enters decision-making, and I hope it stays that way, but I do worry about it.
Would you agree that there's, yeah, amen. It seems to me that there's been, in your time with the Federal Reserve banks, that there's been a trend toward more transparency, more an effort to communicate more what the governors are thinking, even how they're arriving at decisions, the forward guidance that you talked about, all of this. You obviously are a supporter of that
I am.
demystification of the Fed. Is that a trend that should continue, or are we at the right point now about how open the decision-making is?
Well, I think it's an important trend, and I'm very strongly supportive of it. First of all, because I feel an institution that has been given this level of independence in making policy simply needs, as a matter of democratic legitimacy, to explain what it's doing, how it's pursuing the goals that have been assigned to it, and what its analysis of the economy is, and why it's adopted the policies it has. And this is an important part of accountability and transparency. And it's central to the central bank's legitimacy. But beyond that, it's also in its own right a policy tool, because while the Fed's main instrument of policy is how it sets the overnight interest rate, not some decisions, but not many, are influenced by the level of very short-term rates. What matters more are longer-term rates of interest. The 10-year Treasury rate influences mortgage interest rates and other borrowing costs in the economy that influence housing and investment spending, buying a car and other things. So long-term rates, market participants are thinking not just about what are short-term rates today, but what will they be over the next 10 years. And so the Fed needs to explain not just why it set the rate it did today, but what the future path of rates will depend on. It can't make promises about how it's going to set rates for the next 10 years, but it can explain how it thinks about setting those rates and what it depends on. And when market participants have better understanding of that, monetary policy transmission works much better. And after the financial crisis, during those 7 years when the overnight interest rate was at 0, we decided at the Fed to give increasing amounts of guidance about how we intended to set short-term rates for the foreseeable future. And the consequence of doing that was that long-term rates came way down, and I think that helped to speed the recovery of the economy. So it's a policy tool. Communications is a policy tool in its own right.
So we're at record low unemployment right now. Growth last year was certainly above the 1.9 that you
Yep.
referenced earlier. Would you have voted for the most recent rate cuts?
So I'm
I didn't warn you I was going to ask that one.
fine. I certainly see the logic of the rate cuts and have been supportive of what the Fed is doing. So I think the way I see it, the economy's at this point in a good place. The job market is very strong. The unemployment rate is the lowest in 50 years. Inflation is well under control. And if anything, well, it's now, I would say, around 2%. We've had a decade, the last decade, inflation has actually averaged 1.5%. And, inflation can be too high. In much of my life,
Yes.
I've spent worrying about inflation being too high. But we live in a world now where we should also worry about inflation being endemically too low. And after a decade in which inflation has been under 2%, and seeing that there are downside risks to the economy and there are not a lot of evident inflationary pressures, I worry about inflation being too low and not so much about it being too high. And so the economy is fine, but it's slowed, and the global economy is pretty weak. You have deflationary concerns and monetary policy stretched in much of the developed world, certainly in the Euro area, certainly in Japan. And I think the trade policy conflicts and uncertainty is casting a pall over investment spending. So I think, the uncertainty about trade policy is one factor that slowed the global economy, that's having repercussions back on the U.S. in terms of slowing our export demand. And in addition to that, I think it's influencing investment decisions in a negative way because so many investments involve global supply chains and understanding what are the rules of the road. And if I build a factory someplace that has to export parts and eventually all that comes back to the United States, will that be allowable, or can I expect tariffs to go into place? In that type of environment, a lot of firms decide I'm just going to put big projects on hold until the situation clarifies. So I am very worried about downside risk to the economy. I think that means that having somewhat more supportive financial conditions to keep the economy on track. The economy's slowing. I mean, the job gains continue at a pace that's probably more than what's sustainable still. with a constant unemployment rate, but there is some loss in momentum. And I think, we have a mini manufacturing recession with maybe some signs that it's spilling over to the rest of the economy. So recession risks are higher than I would like to see them, and some attempt to address that, which is what I think the Fed is doing, I would probably be supportive of.
Just, I could go on forever, but you don't want to. So just a couple of other thoughts. If we had had a more, let's say, conventional or orthodox trade policy, would you have expected to see the results from the tax cut that were promised? In other words, there was a lot of hope for a lot of investment being spurred by the tax reform, and we're not seeing that. And my question is, how much of that would you chalk up to the headwinds in trade policy?
So analysis that I've seen bipartisan on the likely impacts of the tax package that was passed suggested there should be some improvement in investment, and faster investment would lead to some speed up in growth. But the numbers are not huge. And when you really sit down with a sharp pencil and try to work out what could you reasonably expect, we're talking about 0.1%. So this wasn't the type of package that analysts would have thought, oh yes, that 1.9% that the Fed's writing down as the long-term growth rate, that should speed up to 3 or 4 or 5. If it went to 2.1 or 2.2, in fact, that would be a very substantial payoff, and that would be the top end of estimates that I'd seen. So would it have had a payoff? Yes, but not the kind of number that some people might have hoped to see. So that's what I think a realistic analysis would have shown, and I think we did see some improvement in investment spending after the tax cut was passed, but now investment is actually declining. And so I do think the trade policy and slowdown in the global economy has made a difference to that.
So we're in the longest expansion on record, and so every month is
Yes.
a new record.
Yes?
I assume you'd agree that it's not going to go on forever. So what's your outlook?
Well, in any year, the odds, knowing nothing about the economy, of a recession are around something in the 15 to 20% range. So it probably would be safe to forecast that there will be a recession somewhere in the future. But typically, recessions or expansions don't just die of old age.
Okay.
And usually there's a reason that they end. And the two most significant reasons are that inflation picks up to unacceptable levels, and the Fed then needs to tighten monetary policy to address that. And the other reason is financial imbalances, whether it was the stock market bubble or the housing bubble or some financial excess. And so, with respect to inflation, I must say I'm slightly amazed that we've got a 3.5% unemployment rate and we're not seeing inflation pick up.
Mm-hmm.
And that's fantastic. But I don't see inflationary. I would be careful about watching for that, because eventually, if the unemployment rate, if the labor market gets tighter and tighter, I do feel eventually we would see inflation. but that doesn't seem to be in the offing now. So I
Right.
don't think that's what would end this expansion. And I think we have a safer financial system now by a long margin than we did in the run-up to the financial crisis. There are trends that I worry about. I suppose overall I would say that financial risks are moderate, so I don't expect a financial crisis to be what ends this expansion. I do worry about non-financial corporate debt. There's been a substantial buildup in it. I am worried about lending standards in leverage lending, for example. Asset valuations are very high, but on the other hand, interest rates are low. There are some things where I would say there are orange lights flashing, but if you ask me, do I think that financial excess will be what ends this expansion, I would say I don't see that in the cards. So, you know, this expansion certainly could continue, but I do see the global economy and the trade policy as creating quite a bit of downside risk. So if you ask me my recession probability, it's certainly well above the normal 15 to 20%. I don't think it's the most likely thing, but I am worried about it.
So but this problem of grinding slow growth, and how much should we fear deflation? Deflationary impulses? I mean,
So outright deflation I regard as very unlikely.
okay, good.
And even in Japan, that actually had mild deflation and decades of struggling with it, we didn't see serious outright large declines in the price level. So it's very unusual for prices to decline absolutely, and wage cuts, which would tend to foster that, only tend to occur in very depressed circumstances. I'm not terribly worried about outright deflation, but I do worry about inflation expectations slipping, and I think there is some evidence that maybe inflation expectations have declined somewhat. And the problem with that is that if inflation, instead of being 2%, which is the Fed's target, were to continue to average 1.5%, let's say, you say, well, that's a small shortfall. But inflation expectations are an important driver of actual inflation. So if inflation expectations begin to fall, that tends to pull down actual inflation. And when inflation falls, that tends to pull down interest rates more. And now you're getting into a world where the scope for monetary policy, which is already quite limited, is getting more and more compressed. And so I think that's a very dangerous situation. And, well, we should surely avoid high inflation. I would really want to defend keeping inflation around this 2% and not, what I worry about is when the economy is operating normally and the Fed is not at zero interest rates. If it's successful in having inflation average 2, that's good. But a large share of the time we'll have shocks in the future. Interest rates will be cut to zero again. I don't think this is the last time it's going to happen. And then inflation will fall below 2%. And when I talk to market participants, they say, oh, I don't expect over the next 10 years inflation will be 2% because, there'll be times when everything's fine and inflation will average 2%. And there'll be times when we're in recession, it'll average below 2%. And gee, that's not 2%. That's sometimes 2% and sometimes below 2%, and that's an average that's not 2%.
Right.
And that's the logic I worry about.
Last question. So much of the United States economic security comes from the role of the dollar. How would you rate the danger of a multi-currency world, or at least a two-currency world, where the dollar is no longer the reserve currency?
I think that's a very difficult transition. The dollar is utterly dominant, and I can't see what currency has the fundamental properties to replace the dollar as a global reserve currency. That said, there's a good deal of discontent around the world with the dollar. And with the dollar as the reserve currency, the United States plays a huge role in terms of being able to enforce sanctions, counterterrorism, anti-money laundering. And, sometimes when the world agrees that they agree with what we're trying to do, we have, they're willing to go along with that. But when there are conflicts, for example, as has occurred over Iranian sanctions, you hear more and more talk about active efforts to try to create an alternative to the dollar by other countries that are being shut out of the global payment system. But it is very hard to find something else that could replace the dollar for the foreseeable future.
Well, Dr. Yellen, congratulations on the medal. Thank you for coming to Kansas City and
My
spending the
pleasure.
time with us.
Well, it's an honor. Thank you. I really enjoyed
thank
it.
you very
Thank
much.
you. Thank you so
Thank you.
much, David. Thank you so much.